All
Un-
right. Welcome back, everyone, ladies, to week two of Money Talks with Padma. Last session, we learned inflation has apparently been eating our money faster than our kids eat snacks. My name is Madhvi Kasturi, one of the admins of Cleveland Moms for Moms, which basically means surviving on WhatsApp notifications and coffee or tea. Joining us back today is Padma Jamie. Padma has specifically requested that we don't mention her long list of impressive qualifications. So here is our reluctant celebrity, Padma Jami. Tonight, she'll be breaking down public market basics in a simple, real life way. So hopefully, terms like markets, investing, these words going to be sounding a lot less intimidating by the end of this session. A few quick housekeeping reminders. Please stay muted throughout the session. Kindly enter questions in the chat box only. Our Banu Bhanumati Maheshwar, our fellow super admin, will be taking the questions and reading the questions anonymously to Padma. As always, no jargon, no politics, just fun conversations, learning, and finally question and answers. With that said, over to you, Padma.
Thank you, Madhvi. That was very sweet of you. Today's topic is public market basics. Public market, as you all know, is like really exhaustive. I'm trying to make it as simple as possible for you. So before we dive in, a quick 30-second recap for everyone who was here last week, and a fast catch up for anyone joining us for the first time. Session one was about building your financial foundation, 6 ideas. Oh God, sorry about that. 6 ideas. Money is a tool, not a goal. Inflation quietly eats savings. That's it still, as Madhavi said. Compounding is the superpower that grows them. Small amounts, long horizon, and big outcomes. Okay, so remember that. Buckets, spending, saving, investing, keep your money organized. Your emergency fund is your seat belt. Before any of this matters, debt comes in two flavors, the kind that helps you and the kind that hurts you. That was the foundation. Today, we'll put it to work. That's the goal. So, welcome to session two, public market basics. In session one was all about organizing your money. Session two is all about putting into work. Today, we are going to understand how public market work and how they can help us all build wealth. How many of you have heard, someone in your friend group or your circle, a partner, a sibling, a friend, talk about market? Market is up, market has crashed, and maybe you nodded about and thought, whatever. Today, we are going to demystify all that. By the end of the session, you all will be the one that is explaining in the next potluck what the market is. Okay, so that's the goal. So you must be hearing about S&P 500, Dow Jones, Nasdaq, probably in the news, probably from someone. We're just going to see if we can learn a little bit about all those things. First of all, it's 9 p.m. and the fact that you all are here instead of binge watching Netflix or something like that tells me two things. One, you're serious about this whole finance thing that we're doing. Second, you have incredible stamina. I promise to keep this interesting enough that nobody falls asleep. Okay, so that's my goal. Let's start with the basics. Okay, so what exactly is this public market? Public market is simply a place where regular people, not just millionaires or Wall Street bankers, can buy and sell. Okay, so not we can when company goes public, it means anyone with a brokerage account, put a pin on that brokerage account, we'll be talking about it tomorrow, can become part owner. So you have an account and you become a owner of the public market. Now, how does a company go public? Okay, so that's called an IPO, initial public offering. Before an IPO, a company is private. Only the founders, employees, and early investors own shares. The public cannot buy in. When the company decides it wants to raise money and let the public invest, it does an IPO. Okay, that's a simple thing that you need to remember. It sets a price per share and offers those shares on the exchange. For the very first time, all of us can go and buy it. Why would a company want to do that? Why would they want to go and sell the shares in the first place? Why give up their ownership? There are a few big reasons for that. One, to raise capital. Okay, building a business takes enormous amount of money. Factories, technology, hiring, and marketing. An IPO can raise billions in one day. Single day, they'll just get billions of dollars. When Google went public, just to put things in perspective, when Google went public in 2004, they raised 1.67 billion in one day. That money funded the growth. That turned into most powerful company on earth. Second, to reward early investors and employees. Okay, the people who bet on the company early, the venture capitalist, the who funded it, the engineers who took stock options instead of salaries, they can finally turn their paper wealth into real money by selling the shares in the public market. That's the big payday that you hear about in Silicon Valley very often. You'll be hearing, oh, today is the big payday. That is because these guys have an access to the public market to sell. Third, credibility and visibility. Being publicly listed means the company has passed the regulatory scrutiny. The SEC reviews, SEC is the organization that reviews all your stock exchanges, has, before everything, before an IPO. So it signals to all the customers, partners, and talents like you all, like engineers and people, that it is a serious, transparent company. So it's like getting a stamp of approval that it's a good company. That's what it does. Fourth, companies sometimes issue additional shares after the IPO. That's called secondary offerings. You don't have to think about it, but those are the times sometimes you get more access to these shares. So to raise money for expansion, say for acquisitions or paying down their own debt. So the key takeaway, when a company sells shares, it's trading a piece of ownership to you for cash to grow their business. And that's good for you as an investor because growing a company means, sorry about this, I don't know, some kind of a tech issue. Okay. Means your shares become more and more valuable. Okay, so that's the thing. You probably heard about big IPOs in the news. When Airbnb went public in December 2020, yeah, 2020, yeah. When Airbnb went public, stock opened at $146 per share, nearly double of the IPO price that they set. They set for 68. It opened at $146. When Rivian, the electric truck company, went public in 2021, it was valued at $100 billion, 100 billion with a B on its first day. These are exciting moments. Okay, so when something is going for an IPO, it's exciting. Some stocks soar on day one and then drop the following months. For everyday investors like us, it's usually smarter to wait and buy after this dust settles down. Okay, or just own the whole market, which I'll be talking about. Okay, so I wanted you to look at these numbers. The US stock market is worth $50 trillion. Trillion with a T. That's the combined value of all public traded companies in America. There are over 4,000 companies that is trading listed on major exchanges, all the exchanges put together, companies you use every day like your Apple, Google, Amazon, Costco, Target, whatever you name it, that falls under that 4,000. Here's something wild, to put this 50 trillion in perspective for you. This is really important. Roughly half of that 50 trillion, about 25 trillion, sits in only 8 companies. Okay, so the next, the 3,992 companies are the rest 25 trillion. 8 companies are valued at 25 trillion. You all know those 8 companies, so I don't have to say, but anyway, it is NVIDIA, Google, Apple, Microsoft, Amazon, Facebook, Tesla, and Berkshire Hathaway. Just these 8 gobble up 25 trillion. So when you buy an S&P, which I'll be talking about later, you are putting about 35 cents of every dollar that you're going to invest in these 8 companies. Okay. So we'll come back to this. Just put a pin. We'll go back on diversification slide. Okay. The lesson is not here. The lesson is not don't buy the index. The lesson is even owning the whole market today comes with a little bit more concentration than most people realize. So that's the takeaway. And here's the number that might surprise you. 58% of US households own stock in some form. That means, either you have a 401k or you have an IRA or anything like that. So you still have some kind of an exposure to the market. What is sad is the rest of the percentage, right? So rest of the 42% are not exposed to the market at all. So I wonder how they're growing their money. So that's something that we are always trying to think about. So 58% holds some kind of, stocks or in your 401k and all that. And the next chart I want you to see, this is very, very, very important. The public market, what we are learning today is about 50 trillion in the US dollars, I told you. The private market companies you buy on the stock exchange, you cannot buy on the stock exchange. Or venture capital and all the private companies is about 13 trillion with a T globally and growing faster than the public side. Okay. So your Costco shares, your 401k and your S&P 500, that's the big magenta bar that you're seeing, public. Okay, that's the big one. The smaller pink bar is companies like SpaceX, Stripe, ByteDance, Anthropic, OpenAI. I know you've all heard these companies. That's why I picked companies that you probably heard about. These are all sitting in that private bar. So, but you simply can't go into any account and buy them. Okay, that's a completely different world with different rules, different taxes, different risk. We can talk about that. We're going to do one full session on that later on so that at least you all know that it exists. Public is the front door, private is your back room. Okay, so that is what I want to leave you with today. So because we will come to that private market afterwards, but let's understand public first. Now look at this number, 86%. 86% according to Blackstone is of these companies with revenue over $250 million. $250 million. We're not talking about huge companies like what we spoke about, the big 8. But these companies with revenue of $250 million, that is real, that's meaningful, and established companies are all private. Okay. Only 14% are public. So that's something that I want this to land into you just for comprehension. 86 companies, 86% of the universe and companies in the US are private. Only 14% is where you all and we all and everybody else is investing in. You can't buy it through normal brokerage, but that's not a flaw in the system or something. It's just the public market is still the right starting point for almost all of us. It is important to know that the public market is only tip of the iceberg. And there is much more below the water, that bigger world, which we will unpack in future session, how it works, who can access, what the risks are. Maybe it will make sense for you at some point, sense for you and your family some point down the road. Okay, that's the goal. But today we'll only concentrate on public, but you should know that there are private markets available. Think about it that way. You shop at Costco every week, right? I do. So I know that. You buy rotisserie chicken, they're big, giant bags of basmati rice, and then paneer. What if I told you that instead of just spending that money at Costco, you could also own a piece of Costco? Okay, what Costco makes money from all those millions of families like us shopping there, A tiny bit of the profit comes back to you as an owner. That's what the public market lets you do. That's exactly what we're going to see. That's what public market lets you do. I gave you an example because that's so easy to relate. So we know public markets let regular people own pieces of companies. Let's zoom in on the most important type of investment in public market, which is the stock, right? So stock is literally a tiny, tiny slice of ownership in a real company. When you buy one share of Apple stock, you own a fraction of Apple. Okay, a very tiny fraction. You should know that, and you're still a legal owner. You have a claim on Apple's profits. That's a powerful idea, right? That's really powerful because whatever profit they make, whatever product they introduce, whatever they do, you have a share in that just because you own that tiny bit. When the company grows, when it sells more products, enter new market, increase profit, your slice becomes very, very valuable. That's how stock prices go up. Okay. So you didn't do anything extra. The company's growth did the work. Some stocks also pay dividends. What does that mean? There are regular cash payments to shareholders. Think of it like the rent you get from owning a property, right? Except you getting it from owning a piece of a company. Instead of the home, you're owning a piece of company. Not all stocks pay dividends. Some give you growth, but some of them do. But many established companies do. Okay, so now stock prices will go up and down daily. That can feel really scary for you all. But here's the key insight. Over the long term, I want you to take away this. Over the long term, we're talking about 10, 20, 30 years. The overall trend of the stock market has always, always, always been upward. You can't show me a single time in 10 years or 20 years or 30 years that the market was down. It's never been. The overall trend is like that. Since 1926, let me put it in perspective. From 1926, US stock has returned roughly 10% per year on average. You know, there have been crashes, there have been recessions, there have been scary headlines, but patient investors have always, always been rewarded. I spoke about 100 years of stock market. Let me give you a real example. If you had bought Amazon stock in 2010 for $1,000, okay, it would be worth 20,000 today. I made this calculation for you, so it's for real. And if somebody is holding it, they'll agree with me. But here's the thing. During those years, Amazon stocks dropped 20% or more at least 4 times. At least 4 times. I'm talking from 2010 to today. At least 4 times, stock just crashed. Okay? But if you had still waited, you made more money on that. If you panicked and sold during a drop, you would have missed all that growth. Some of us who held on, most of us who held on, who treated their investment like an FD, didn't touch, they did come out ahead. That's the truth. Okay, so think about home ownership in America. If your family bought a house 15 years ago, it's probably worth a little more now. Okay, stocks work the same way. The companies in the S&P 500 have grown in value because the economy grew. You're just owning company shares instead of a physical property. The patience is the same across. Okay, so think about it. You go to Costco every Saturday, you load up the cart, you swipe the card, you come home with 40 pounds of basmati rice, you and whatever you wanted for the house. What if instead of just giving Costco your money, you owned a little of that Costco, right? Now, every time other family fills their cart, a tiny bit of that profit comes to you. You're still buying the basmati rice, but you know that basmati rice, that you're still buying the chicken or the basmati rice, but now the chicken is also buying you a retirement. That's how you should think of it. Okay, that is what stock ownership is. When you own a stock, you're not gambling. You are a part owner of a real business. So think like a owner. If you are a owner, you want to know more about it, you know everything about it. That is the point I'm driving to. Please know what you're investing in. And so that, you know, you're the owner. Take that responsibility, ownership. Company works for you while you sleep. That is what shifts when you stop being a customer of these companies and start being an owner. So think about it. Whatever, go back and see whatever is there, and then you will see that You own a piece of the company. You don't need to pick winners. So that's the point I'm trying to get into. The next one is bonds. Okay. So we just spoke about stocks are all about ownership, right? You buy a piece of company and you're hoping it grows. Bonds work differently. So with bonds or fixed income or whatever the thing, it's all the same. Okay. With bonds, you're not an owner, you're a lender. So just think about that concept. You are a lender. Bond is basically a loan. Okay. So when you buy a government bond, you are lending money to the US government. Okay. When you buy a corporate bond, you're lending money to corporates. Company like Microsoft, Johnson and Johnson, whatever that corporate bond is. In return, what do they give you? They promise to pay you back the full amount on a specific date, plus they give you interest payments along the way. That's what they do. Bonds are generally lower risk than stocks because you have a contract, okay, a legal promise that says exactly how much you will be paid and when. Doesn't matter how the company is doing, not doing, you're going to get paid off. The trade off is that the returns are typically lower than the stocks over long periods. So a US Treasury bond might pay you 3 to 4% per year, while stocks have historically paid, say, 10 to 12%. Think about it. But 3 to 4%, there's no risk. So why would anyone buy bonds? Okay, that's the question you should have. Oh, stocks is going to give me more. Why should I buy bond? Because they provide stability for you. When the stock market drops 20%, your bonds are usually still paying their steady interest that they promised through the legal contract that they will pay you. Okay, they are the seat belt in your investment portfolio. You hope you don't need the protection, seat belt. You don't need the protection, but you're always glad when the roads are bumpy. Yeah, that's how to look at it. A balanced portfolio typically includes both stock and bonds. The younger you are, probably you will hold more stocks, and as you get closer to needing the money, you shift more bonds for stability. We'll talk about that in the other slides. Bonds aren't only the safe option, right? There are a couple of simpler options like short-term choices about CDs, and CDs when you give back bank a lump sum and for a fixed period, say 6 months or a year, and then they guarantee you a specific interest rate. Right now, you can find CDs paying around, say, 4 to 5%. The catch is your money is locked up until the CD matures. And if you pull it out early, you pay a penalty. That's with the CDs. Second, money market funds. These are the hybrid between savings account and bond fund, what we talked about. They invest in short-term, safe debt, T-bills, short-term corporate, smaller duration bonds. The big advantage of this is liquidity. You can usually pull your money out anytime without penalty. You can, and right now they are paying really competitive rates because of the markets, how they are, and the interest rates, how they are working. Many people, here is where you need to park your emergency funds. So now remember session 1, we talked about the emergency fund, 3 to 6 months of expenses set aside before you invest $1. Okay, the question everybody had that time was, where do I actually keep this money? This is where it connects, right? Your emergency fund should be kept in short term. You shouldn't be keeping it in stocks, because if it falls 30%, the same week your car will break down. It invariably happens. So that's the worst possible timing that could happen. But it also should not be sitting in a checking account earning zero. Okay. A money market fund is a short-term bond fund. It's a sweet spot for all your emergency funds. So it will quietly earn you that 4 to 5% while it is waiting for 2 years or something. Think of it as giving your seatbelt a small side hustle. Okay, so that's how you look at it. So if you went home after the first session and set up some emergency funds, great, you're ahead, right? Now the next step is making sure it is parked somewhere like this. So high yield savings account, a money market fund, a short-term treasury fund, some safety, better returns. Your emergency fund should work for you even when you're not using it. Okay, that's the thing. So think of bonds like a certificate of deposit, right? A CD at your bank. You lock up for a set period and the bank pays you a guaranteed interest rate. A bond works the same way, except you're lending to the US government or a corporation instead of a bank. Just to look, you already know about CDs and FDs and all those things. So these are, if your family has CDs, you already understand that concept, right? US government version is called a treasury bond. It's considered the safest investment in the world, not just US, because the US government has never ever failed to pay back, or there is something called credit rating where we will talk about when we deep dive into bonds, where why the rating is always a big AAA for this US bond. So put a pin on that. We'll come back when we talk in fixed income. I'm going to have a deep dive. We'll talk about it there. Okay, so if you're really saving for a house, you want to buy in 2 to 3 years, you wouldn't want to put that money in the stock market. Here's where you want to put. You want to do it, but you also don't want to be sitting in savings account. I told you. So this is where it comes. It's the best way to put it. And all these, your emergency fund should sit in short-term bonds and short-term T-bills. I know what you're thinking. Bonds sound about as exciting as watching rice cook, right? It keeps cooking. And you're right. That's the whole point. Nobody has ever panicked at 2 a.m. because their bond went up 4% or the bond fell 6%. Not even once, not even close. So the bonds I want you to see as the dal chawal of your portfolio. No one posts it on Instagram. You will never see anything about bonds on Instagram. It's what actually keeps you alive, actually. Stocks get the TikTok highlight reel, but bonds are the ones that gets you through the week. Bonds are not exciting. They are not supposed to be exciting. They are the seatbelt, quiet, invisible until one day they save you. Okay. Every grown portfolio has both the engine and the brakes, so the stocks and the bonds. Okay, that's how you look at it. Okay, it's a steady income. Stocks will make your portfolio grow. A balance is always required. Now, we have covered stocks and bonds. These are two important, biggest building blocks in the public market. But public market are actually much, much, much broader than that. Let me quickly introduce 4 other asset class you can access through public markets. You can see it on the screen. So you don't need to invest in all of these. I want you to know that they exist. Okay. If you're a beginner, don't invest in all of this. I just want you to know that these things exist in the public markets. First, real estate. You don't have to buy a house or an apartment building to invest in real estate, right? REITs, real estate investment trust. You must have heard of it. Let you own a share of commercial properties like shopping malls, apartments, complexes, hospitals, name it, and office towers. And today, the biggest craze is data centers. All this you can get through owning a real estate. Okay. You can buy REITs on the stock exchange, just you would buy like a Apple stock. Some popular REITs that are really, really famous and probably you all know is that they own cell towers across America, or the company that owns the Amazon space, Amazon warehouse space Amazon uses for shipping, right? Those are all owned by these funds and you can invest in them through that. Second, commodities. They are raw materials, right? Gold, silver, oil, natural gas, wheat, corn. You can invest in commodities without ever touching a barrel of oil or a gold bar. Okay, gold especially has been a very, very popular hedge in the last, I would say, 2 to 3 years, or more so in the last 1 year. Last 6, 7, 8 months. When stocks are down, gold often holds the value or goes up. Okay, many investors keep a slice of gold in their portfolio as insurance. Okay, this is something that it's available in the market, in the public market. You don't have to go buy a billion of gold and keep it. Third, currencies. The foreign exchange market, Forex, is actually the largest financial market in the world. You would not believe it. You would all think that it should be the stocks and the bonds. But this Forex, the currencies, it trades about 7.5 trillion with a T every single day. In one day, the currencies trade at 7.5 trillion. Most of us interact with currencies when we send money abroad or travel, when we go for our vacations. But currencies are also a full asset class, right? You're not going to invest here. It's going to know it exists as part of the public market landscape. It's like comes down the lane, but I want to leave you with not knowing what is there in the public market. This is one of the things. Fourth is the infrastructure. There are investments in things like toll roads, bridges, utilities, pipelines, data centers. Infrastructure funds invest in physical backbone of the economy. They tend to generate steady income like bonds, because people always need electricity, water, internet. All these are required all the time. You can access infrastructure through specialized ETF and funds that we can talk about later. So the big takeaway, public markets are a full menu. In the menu, not just two items, stocks and bonds, they are the main course, but these are the asset classes add flavor and balance. As you get more comfortable, you might want to add a REIT or a gold to your portfolio. For now, just knowing they're available puts you ahead of so many other investors. Okay. Think about the house you live in or rent. Okay. That property is generating value either through price appreciation or through the rent. You rent, your landlord collects, or you are the landlord who collects. Okay. REIT lets you tap into the same wealth building power without needing a 300,000 down payment, right? You need to put in what, 100,000 down payment, even if you're taking a mortgage and then you're trying to get rent out of it. You could invest $100 in a REIT ETF and instantly own a tiny piece of hundreds of commercial properties across America. Hospital, malls, storage units, data centers. It's like being a landlord without fixing toilets. Believe me. If you're thinking that you will buy a home and you will fix it and you will get the rent, you got to fix the toilets too. But there's another way here. The same amount you're talking about, if you're buying a house, you're talking about 250,000 or 300,000 to get some $1,000 or $1,500 rent. On the way, you have to do so many other things also. So that's something that I want to leave you with, that these are available in the market, in the public space, and you don't have to lose your sleep over that. Gold is something that many of our families already understand and value, right? We come from that culture. It's been a culture for generations. In the US, you can invest gold through an ETF without worrying about safety or security or storage, whatever. During the 2008 crisis, when entire financial market crashed, stocks dropped about 40%, gold actually went up. So these are some things that's why some always tell you to have maybe 5 to 10% in your portfolio as a safety net. Gold is always a good thing to have in your portfolio as a safety net. It may not do well, but if 5 to 10% is not doing well, you wouldn't mind if the stock market is giving you 20 or 25%. It's okay. But when it doesn't, when it falls 40%, and when this rises to give you, you will appreciate it. So by the way, our families have been doing this for centuries. This is not new to them. Some hold gold in the locker, a flat in Bangalore, fixed deposit in ICICI Bank, and cash in the steel Almera, right? We are used to all these things. Our grandmothers were running diversified portfolios before Wall Street had a name for it, right? Our grandmas did that already. They just did not have a terminal, Bloomberg terminal. If ever they had it, they would have done even better. So same wisdom. We are just adding modern tools. That's all it is. The public market is a wide menu. You do not have to order everything today. You should walk away knowing the menu exists, and you do not let anyone tell you what you're allowed to buy or not. That's my goal. Next, the important slide. Okay. Now we understand stock and bonds, even some beyond stock and bonds. Now let's understand the relationship between risk and return, because this is the concept that helps you make smart decisions about which investments to choose. It's very important that you understand the risk that comes along with whatever returns it gives. The fundamental rule of investing is, this is the fundamental rule: higher returns always come with higher risk. Stocks can give you 20%, 15% average returns, but they can also drop 30% in a bad year. Bonds give you steady 4%, but they won't make you rich. Okay. A savings account is safest, but it won't catch up with inflation. There's no investment that gives you high returns with zero risk. And if someone promises you that, if someone ever promises you that, please turn around and run away, because that's the least thing I can tell you. If somebody is telling you there is zero risk, give your money, I can do this, you got to just turn around and run. Okay. Here's the good news. Time is the greatest tool for managing risk, because I'm not going to make it more complicated for you talking about beta, alpha, and all that, because those are jargons that I decided not to engage in when talking to you. So I just want to tell you, time is your greatest tool managing risk. If you invest in the stock market for just 1 year, your returns could be anywhere. See, look at the slide, okay? It just goes minus 40 to 50. It's a wide range. But if you stay invested for 20 years, history shows your return cluster between 6 and 17%. We are talking about 100 years. Can you look at the slide? S&P 500 annualized return ranges from 1926 to 2025. Okay. So the market drops are normal. Stock market has always has a correction, always 10%. This is the thumb rule. Okay. Because I've seen markets over so many years. I'm telling you this. This is the thumb rule. Stock market has a correction, a drop of 10% or more, roughly once a year on average. Okay. Roughly once a year. It might be two times, twice a year, but it happens. Stock market has a correction. It has a bear market. Correction means it will be somewhere between 10%. Bear market happens. It's a drop of 25% or more, roughly every 3 to 4 years. You can go back and see. There will be incidents for you that it has fallen 20% or more. Okay. So this feels terrible when they happen, right? But they are a normal part of how market works. That's why I'm normalizing it for you, that markets will have correction every year, maybe once for sure, maybe twice. Bear markets will happen 3 to 4 years. It is something that happens. Don't worry about it. The market has recovered from every single downturn in the history of United States. That's something that I want you to know. Remember, in session 1, we called compounding the eighth wonder of the world. Here is where compounding and risk connect. Okay. So compounding needs one ingredient to work its magic. And you know what that is? Time. Time is also the single best tool for managing risk. So the same force that makes your money grow is the same force that makes the scary ups and downs disappear. Okay. The chart of the slide is basically the visual proof for you. Okay. Of the session 1 biggest lesson: start early, stay patient, is not just a feel good slogan. It is backed by hundreds years of data. Okay. So it's 100 years of data. I have it for you here. This is what it is. Look at the chart. This is the single most important picture in today's session. I really want you to think about it. 4 bars. Each one is a range of S&P 500 returns, has actually delivered over the last 100 years, depending on how long you held it. Okay. Start with the bar 1 year bar. Hold the market for just 1 year and your return could be anywhere negative 40 to positive 50. That's a 90-point range. Okay. That's terrifying. That is why your stomach hurts when CNBC tells you the market dropped today. You know, it just feels bad. Negative 10, that's for anyone to take is bad when you don't know the markets. Now you will know the markets, you will not feel that bad even if it falls. Okay. Now look at the second bar. It's 5 years. The range tightens. Okay. Negative 10% to positive 25%. Still wide. Okay. If you lose 10%, you still feel bad. It is still wide. But the worst case is much less scary. Now, 10 years. I want you to think negative 2%. You sometimes you must have lost a negative 2% to positive 20%. Almost entirely above the line, just a little. Okay, now 20 years. Look at that. Isn't that something like amazing to look at visually? 6% to plus 17%. What does that mean? Can you take a guess? It's like, look at that. The worst 20-year period, the worst 20-year period, including 2008, if you want to put it in there, in the last 100 years, still made you 6%. That's something that I want you to walk away with. The bar is entirely above zero. There is no losing 20-year period in the history of the United States stock market. I'm being very positive here. Not just being positive, I'm giving you data. Okay, anybody can go check. Wherever you want, ask your chat GPT, ask whatever is at your fingertips. They will tell you there is no losing 20-year period in the history of the United States stock market. That's very good news for you, so that you'll feel confident about getting into the markets. Okay. The lesson is not that market is safe. Okay. I'm definitely not telling you a lesson that the market is safe. The lesson is that time is what makes it safe. Risk is what happens to people in a hurry. Okay. Wealth is what happens to people who wait. Carry this with you. Lesson is time is what makes it safe. Risk is what happens when people are in a hurry. Wealth is what happens when people happens to people when they wait. And this is the critical point. Stay invested through downturns. Historically, patience has been rewarded. The worst days, take this. This is very important. The worst days and the best days in the stock market often happen close to each other. Okay. There's a day when 30% dropped. There's going to be a next day when it went 20%. I want you to take this away. And you can never get back into the market when you decided to sell when it fell 30%. You will never do it. I'm telling you. If you panic and sell during a crash, you often missed it. You missed the upside of the market. Happens to every one of us. So that's why, go back to my first slide. Money is a tool. Just let it do its work. Don't put the emotions into it. Remember March 2020 when COVID hit? That is not very far off. You all can remember that. The stock market dropped 34% in about a month. Okay. In 1 month, the market lost 34%. If you had $100,000 invested, it suddenly looked like $66,000 on your screen. Terrifying, right? But if you did nothing, if you just held on and maybe added a little more, you, by the end of 2020, I'm not talking very end of 2020 is 6 months later, you would have been back to 100,000 and some. By the end of 2021, it was about 130,000. So yes, 100,000 went to 66. But if you got scared and pulled it out, I promise you, you never made 130,000 by the next year. Okay. Those people, those the families who panicked and sold in the market, literally locked in losses. And I can guarantee you that they have locked in their losses just by being scared about what's happening. And same thing about buying houses, right? Think about the families who bought homes in 2006, right before the crash. Home value dropped 40%, right? Terrifying again. But the families who didn't panic sell, by 2015, most of this home had recovered and some, so it was not bad. Real estate takes a little bit longer to catch up of the cycle than stock markets, because the geopolitical news and everything happens right there at the stock market. So the same principle applies. Time heals market drops. Don't do anything thinking that, you're going to sell it and get it in at the right time. It is never going to happen. Patience isn't just a virtue. Believe me, it's wealth building strategy. I want you to think of patience as a wealth building strategy. As we say in Hindi, right? Sabar ka phal meeta hota hai. So the fruit of the patience is sweet. So let's just wait, go with that. When the market drops 30%, there are two types of people. Okay. Type 1 checks their portfolio every hour, panics, sells everything, and then tells everyone at the party that investing is a scam. Don't even invest. I've heard so many people say that. Oh my God, this investing is a scam. It's only for Wall Street guys. No. Type 2 does not even notice because they're so busy yelling at their kids about homework. These are the people that retire comfortably. The secret to investing is not intelligence. Okay. It's the ability to ignore your phone and the noise. That is what is the secret. Risk is not the enemy. That's what I'm telling you here. Not understanding the risk is the enemy. The market has recovered from every single downturn in the history. I want to take that. I want you all to take that. The investors who did not recover are the ones who sold. So that is I can even give it like a bond contract note. That is what has happened. They have sold at wrong times. If they just stuck with it, they made more money. They have been happy, and they wouldn't call investing a scam. Okay. So next, diversification, when you never put all your eggs in one. Okay, so we talked about stocks, bonds, relationship between risk and return. Now here's the strategy that ties it all together: diversification. This is the single most important concept in investing. Okay, you diversify, you're diversifying the risk as well. Okay, means spreading your money across different types of investments, so that if one goes down, you're not wiped out. Okay, so you're not wiped out. It's the don't put all your eggs in one basket kind of a thing. Okay, so think of your portfolio like a thali, right? So nobody eats just rice for dinner, right? Or lunch, whatever. A proper thali has a little bit of everything, and each item serves a purpose. So stocks, they are your spicy curry. Okay, that's where the bold flavor comes from, and the growth engine of your portfolio. Without it, the meal is bland. So, but you won't eat a whole plate of just curry, right? So you need rice. Bonds are the rice. Okay, steady, reliable base that holds everything together. Not exciting, but take it away and the whole meals fall apart. Cash is the yogurt, okay? Cooling, calming, always there when things get too hot. So your emergency fund, that's what it is. When the market drops 30%, everyone is panicking. Cash is what lets you sleep at night and not sell at the bottom. That's what it is. Gold is the pickle. Okay, small portion, but it adds a punch when you need it. Gold tends to shine exactly when everything else is struggling. Okay, that's the gold's job anyway, even otherwise. You don't need a lot, but having some makes the whole plate better. And real estate is like your roti, the foundation that fills you up, whether it's REITs or actual property. It's tangible, it generates rental income, and it gives you a portfolio, some kind of a substance. Okay, no single dish makes a meal. I just gave you something that we can relate to. No single asset can build a wealth for you. Your financial thali needs a little bit of everything. Our grandmothers already knew this: some gold, some property, some deposit, some cash under the mattress, some wisdom. Use the modern tools. Okay, so the transition to the 6 categories that I have mentioned here is like, I just wanted to explain to you that the whole market has this, and you have to. I already spoke about this previously, but that was ingredients. I'm going to tell you how to make a recipe from here. Okay, so that's what it is. Now, US stocks, they are large and small American companies. All your companies like Amazon, Apple, Walmart, also smaller companies you might not have heard of. The US is the largest stock market in the world, so this is typically the biggest portion of your portfolio, the US stocks. Second is international stocks. These are companies in Europe, Asia, Latin America, emerging markets. Who own this? Because the US economy doesn't. Why own this? Because the US economy always doesn't lead the world. There are years when European or Asian markets have outperformed all the time. So owning a bit of everything means you capture wherever it happens. Like every year, you'll have a different asset class that does well. Third is bonds. Bonds provide stability. When stocks are falling, bonds often hold steady and or even go up. They are the shock absorber of your portfolio. Then you have REITs. We spoke about all these things. They pay high dividends, behave differently than stocks, which is exactly what diversification is all about. And commodities, gold, oil, we told they were the best performing asset class in 2022. If you didn't know, in 2022, the market just crashed. Everything fell except gold. So the infrastructure, we spoke about that as well. Think of it as owning the highway, not the cars driving on it, right? You own that infrastructure. So there is some money that will come out of it. The tolls, that when you pay the toll, you feel bad, but you own the infrastructure. When someone else pay the toll, you will get a dividend. Why not, right? That's the way to look at it. Have a ownership. So you have some money coming out of it. When you feel bad, you also know, hey, I'm also going to get this money out of it because somebody else is running on this with their car, so they're going to pay me the toll, right? That's how you look at it. Remember when I told you roughly half of the 50 trillion US public market sits in 8 companies? Okay, you have to remember that. This is the slide where that number matters. When you buy an S&P 500 index fund, I told you that, you're putting 35 cents of every dollar into these 8 companies. So somewhere in your mind you should question. So even owning the whole market today is more concentrated, right, than it sounds. Most of that concentration is in one sector, because all the companies that I told, 8 companies except barring one or two, is still tech sector, big tech. That does not mean don't buy index funds. Index funds are still the best tool we have. I will tell you what that is. What it means, do not stop there. Add international stocks, add bonds, add small companies. Diversification in 2026 means actively spreading beyond S&P 500. Okay, because the index itself is no longer diversified as it used to be. That's the modern version of don't put all your eggs in one basket, even when the basket is labeled 500 companies. Okay, so I want to tell you a small example. In the late 90s, I was still in India studying, and some of my friends were in Bay Area, and the um, the friend and his wife both were working in Lucent Technologies. This was in 90s. They were not like they were related, but I'm still back in India, so I know this happened. Okay, so Lucent Technology was the hottest stock on Wall Street. Okay, spun out of Bell Labs. I don't know how many of you were there that time, so probably you will relate to it. It traded around $80, okay, a share. Employees were encouraged to load their 401ks with that stock because the stock was just going up and up and up and up. Okay, I know that these two people were in that. Many did. Some had 80% or more of their retirement in Lucent. And you can look up Lucent. ChatGPT is at your hand. So you can just see what is this Lucent Technology late 90s crash. So dot-com bubble burst and the stock fell from $80 to $1, under a dollar. It became a penny stock. So from $80, it just fell to a penny stock. Not a bad quarter. It's a 99% loss. Okay. Thousands of employees, many of them were in their 50s, lost their job and their retirement savings in the same time, same year. Your retirement wiped out and your job also went away. The company they trusted with their career was the same company they trusted with their retirement. So please don't do that mistake. Both will disappear at once. This is the danger of concentration. So that's why diversification is really important. It does not matter how good the company looks, okay, today. If your paycheck and your portfolio depend on the same name, one bad year can take both down. Diversify. Diversify from your employer, especially in tech, where this pattern keeps repeating. It didn't end with 90s. After that, we had so many Sun. We had so many Sun Microsystems. We have so many other companies that came along the way had the same problem. And you all know about the cautionary tale of this Enron, right? It was such a huge thing. During the dot-com crash in 2000, employees in companies, Enron and WorldCom, had their entire money in World stock, then this company stock. When the company collapsed, it happened the same way. So Lucent is not the only one in the tech. Enron happened. And, World, all these things happen. So I just want you to think that, don't concentrate. This is the slide that tells you that one stock can fall to zero. The whole market never has fallen to zero. So this goes back to what I said. 20 years in the stock market, if you have been in there, you haven't lost a penny. Okay. So if you're holding one stock, that can come to zero. Yeah, the whole market will never fall. Okay. And you'll ask me, why does diversification really work? Here is your answer. From 2016 to 2025, I just made a little note of that. Not the analysts, not the fund managers predicted which. No one knew which of these asset classes that I told here will outdo the other in every year. Okay, so one year US stock did, 1 year bond did, 1 year commodity did, 1 year interest. So own everything, know the percentage of what you own. You just need to be in all of them a little bit. That helps you. Okay, the simple diversified mix, quietly compounded through all of it, never will win the trophy for you. I'm not claiming that it will win the trophy for you, but it will never take a worse hit either. So you do not need to be right. You just need to be in all of them. Okay. So that is what diversification is all about. Let's talk about index funds and ETFs. Okay. So we know we need stocks, bonds. We know we need to diversify. How do you actually do that without becoming a stock picking expert? The answer is index funds and ETFs. Honestly, this can change your financial life. Okay, you don't have to sit and look at every stock, their due diligence, what they're doing, and all that. These are like gold mines for you. Index fund is brilliantly simple. Instead of trying to pick individual winning stocks, it just buys an index fund, just buys everything. One purchase gives you ownership in hundreds or thousands of companies. That's what it is. No guesswork, no stress. The most famous example is your S&P 500 index fund. When you buy it, you instantly own 500 largest companies. If you buy Dow Jones, you get all those. Dow has like multiple 1,000 companies, 2,000 companies, 3,000 companies. So you own Apple, Microsoft, Google, whatever you name it, JP Morgan, Johnson and Johnson, Costco, all of them. One purchase, one go, all companies. And here's the best part: simplicity, right? You don't need to research individual companies, following earning reports, which I do on everyday basis, or time the market. An index fund does the work for you by automatically holding on all of those top companies. It's the set it and let it grow approach to wealth building. And historically, it's been incredibly effective. Okay. S&P alone has returned about 10% every year over the last 40 years. Okay. At least for sure, I know for 30 years. That kind of consistent growth is what builds real wealth over time. Okay. And instead of trying to outsmart the market, own the market. It's easy that way. Don't try to outsmart the market saying, I'll do this, I will do that. Invariably, one day it becomes hard for you. Remember the compounding we called the superpower, right? In session one, this is where superpower meets its perfect vehicle. This is where it meets. Index fund returning 10% a year, doubles your money every 7 years. Okay. You put in 10,000 today, do absolutely nothing. And in 7 years, it's 20,000. In 14 years, it's 40,000. In 21 years, it's 80,000. This is not stock picking genius here. Okay. This is not insider information. This is just compounding plus patience plus one boring index fund. Session I gave you, session one gave you the principle. This slide gives you the instrument. The index fund is how compounding actually shows up in your brokerage account. I'll talk about brokerage account next session. So that is what I want to leave you with. Think about dollar cost averaging. Okay, so this is something that is a concept that you all should definitely know about. That's just a fancy term. It's the dollar cost averaging is just a fancy term for investing the same amount every month. Okay, no matter what the market is doing. What does it do? When the prices are high, your money buys fewer shares. When the prices are low, it buys more shares. That's all it is doing. You don't care about what market is doing. You say, I'm going to put $1,000 a month into this index fund. What happens is money buys fewer shares when the prices are low, it buys more. Over time, this averages to a great entry point. Okay, you can set this up for automatic monthly transfer anytime. Your money grows while you focus on your family. Think of it as an auto pay for your future self. Okay, because you auto pay mortgage, you auto pay school fees, you auto pay your electricity, water, all that. Pay something for yourself, auto pay yourself, so it will help you. Except the money is going to you and you will be happy when you retire. The finance industry has a gift, for making simple things sound complicated. I'm sorry to say that, but yeah, it has a gift of doing that. An index fund is just buy everything. Okay, that is it. They cannot call it buy everything because they cannot charge you. You will have to read the prospectus and all those things, but please buy the index fund. The most boring sentence I will say all day is also the most important. Buy the index fund, do not try to beat it, do not try to time it, just be in it. That is how generational wealth is built. Quietly, over decades, by all of us who choose simple over being clever. Okay? We don't want to do that. We'll just do, when we have small, we will just do that way. That's our goal. Next is how it works. Okay, you understand the building blocks now. Stocks, bonds, index funds, diversification, risk. We covered all this. Time to demystify how this actually works when you sit down at a screen. None of this is hard. It just uses words that sound technical until someone explains them in plain language, right? That's all it is. So it is just, so let's quickly think about session one. We organized your money into three buckets: spending, saving, investing. The spending money is your monthly life. The saving bucket is your emergency fund and short term goals. And we just learned on bond slide that a money market fund or short term bond is a safe place to park that. This is the money you will not touch for 10, 20, 30 years, the investing bucket, right? The long term bucket. And that we are about to learn is how to actually put that bucket to work. The mechanics are simpler than you think. First, a brokerage account is just a storefront. Okay, I'll tell you that. It is the place where you log in and buy and sell investments. They are all regulated and insured. So you should know that as well. So think of it as some same way you think about a bank, right? Except instead of holding cash, you're holding investments. That's where I want to leave you with, because we have some timing this thing. So I just need to quickly run through all this. We will go deeper into which of these and all that in the next session. And the easiest way to think about dollar cost averaging is auto pay. So just do it, except instead of paying a company, you're paying for your future self. So carry that with you. This is the only thing I want to leave you with the few traps that you don't want to get into. This is the trap that I want you to think about: timing the market. Okay, number one, timing the market. The instinct on a red day is to sell. Don't. Time in the market always beats the timing in the timing the market. Time in the market beats timing the market. Okay. 2, 4 more bets. Your cousin friend is making a fortune on Tesla or Bitcoin. Every story is like that. There are 10. There are 10 more that you don't hear. You only hear one story that's making. So that's, stay boring. No problem. If you're a beginner, stay boring. Concentration in employer stock. When the company has a bad quarter, your paycheck and your savings should not go down. So no, don't get concentrated. Then I also want to talk about holding Indian mutual funds, but I'll talk to you at some other point. I think that's, I don't know, some of us come with that. So IRS has made some things difficult for that on that angle. I'm telling you, you should talk to your CPA about that. And lifestyle inflation. When raises come, savings should raise with them. So if you get a raise in your salary check, make sure that you also raise what you're putting in for your future self. Because the first session I told you, 30 years you work, 35 years you retire. So you have to earn whatever earnings you're doing, it should come for 2 years for you. So keep that in mind when you do that. So when you get more money, please put aside more. So the boring part is always the powerful part, actually. So it should be that, the version of you sitting in this chair 20 years from now will thank the version of you sitting here today for never having to feel brave. That's the goal that we want to do. And that's it. We bring back, this is your playbook. We've covered a lot of ground today. I want to make sure you walk out of here with four clear takeaways. Public markets let anyone own a piece of great company. You don't need to be wealthy. You don't need to be an expert. Stocks offer growth, bonds offer stability, and a good portfolio uses both. Third, diversify broadly. Don't try to pick or don't time the market. Fourth, start now, start small, let time work for you. Every month you wait is compounding time you can never get back. So the one who starts $100 a month today will be in a dramatically different financial situation in 20 years than one who is waiting to feel ready to invest. You basically just got an MBA in 45 minutes, believe me, except this one was free and nobody asked you to do any group project. So investing is not gambling. Gambling is putting your money on a single outcome and hoping. Investing is planting seeds across a wild field and giving them time to grow. Every dollar you invest is a seed for your family's future. When you understand markets, you understand generational wealth. So, quick 30-second purview for the next session. Next session is about where you're holding it, because the account you choose can literally double or half what you actually keep because of taxes. Okay, 401k, so Roth IRA, then HSA, and 529. We'll talk about all these things in the next session. And thank you. I am here if you want to talk through anything. No question is too small. You came in tonight wondering if any of this was for you. I hope you're living with the vocabulary most people in your life do not have. This is not nothing. This is the start of a generational shift to your family. Thank you for showing up, and please let me know what your questions are. I'm sorry it took a little time because public markets is exhausted.
Bhanuaka, do
to
you have any
you.
questions?
Yeah, back to you, Madhvi.
Okay.
Bhanuaka will be
Yeah.
doing the question.
Yes, I'm not able to get the video on for some reason.
That's okay, Akka. You can just ask the questions.
So, Padma, thank you so much, so much. I also feel like I have a second-hand Harvard degree now. That you said you gave us an MBA in 1 hour.
45
I hope
Not the
everybody
project
felt the
work.
same way.
Yes.
Totally agree on that.
So,
Yeah.
thank you so much for simplifying the basics of the public market and helping us understand the importance of diversification through your multiple examples, which was simple to understand.
Yeah.
And so kind of inspiring and
Thank you.
enlightening and empowering all the moms to think about public markets in a different way. Personally, I loved all the punch dialogues.
Do you have
Yeah,
any
just to
questions?
relate so that I had promised them they should not sleep.
Yes. I mean, you kept even my little pet Alu engaged for at least 5-6 minutes.
Oh, wow. Okay.
So to the moms, I have only a couple questions, I think. One of the questions is, what is the percentage do we need to invest in each one? Um,
Yeah,
not
that's an asset allocation, a topic on its own. So we can, but at least on the broader picture, I would say hold more equities and bonds and little of the other things until you understand. I always want you to understand the risk in what you hold. So once we finish the series, probably you'll understand more risks in each of these asset classes. So for now, I would want you to at least do some equities, bonds, and short-term instruments.
that pretty much. I don't see any other questions. I guess everybody wants to pose it to you
There was
directly.
one more question that Akila posted. I believe it said she wanted to know the full form of ETF.
Exchange
Oh,
traded
right.
fund.
Sorry.
Yeah.
Yeah.
So
That was one other question. What does ETF stand
yeah.
for?
So ETF means exchange traded fund, which means it's a stock. It's like a stock. It behaves like a stock. So ETF is a cluster of all the stocks, but it behaves like a stock in the sense that it is on the stock exchange. It will go up and down. You can liquidate at the end of the day, unlike your mutual funds. So it has the characteristics of a stock, but it's a bunch of stock.
Thank you so much, Padma.
Yeah, no problem.
I think that's about it. I don't see any other questions.
Yeah, I'm not unapproachable. I'm always there. You guys can text, you can ask whatever questions you have. Maybe if something is really worthwhile that I think the whole group should know, I will bring it back and share it with them without giving your names. So please feel
I have
free
one
to.
other question. One other question popped up.
Yeah.
Would love to know, the mom wants to know how to get started, how to open a brokerage account, and what would be a reasonable amount to get started.
Yeah, we are going to do that next week, where I just told you, put a pin on that brokerage accounts, all those things, how to open, where to open, how do we do it, everything starts. I'm going to teach you next session.
Okay, perfect. This is great, Padma. Thank you so much for an enlightening session. Many of us have heard of a lot of these terms before. Many of us have even learned about this in college. Like you said, this was like all of MBA squeezed into 1 hour that you've given us, but they are mainly, I think, our key takeaways for today have been stocks, about owning part of the company. Bonds is lending money to a company, obviously, with lower risks, and index funds, ETFs. I don't know. I mean, I've been taking notes of what you've been saying. So yes, dollar cost averaging, Stay boring, stay the course. Time in the market beats timing in the market, like you say. A lot of great takeaways, by the way. I'm going to like make some of these things for my kids and remind them. But anyways,
Yeah.
thank you once again for so generously sharing your knowledge and empowering all of us. A big thank you to all our admins and all the moms who joined us today. And thank you, ladies. I think we've gone a little over time today, but that's great. I mean, I think we all go back thinking about what the next course of action is going to be. We are really looking forward to the next one, especially I am, especially about, the 401ks and everything, because that is something that a lot of us don't really understand. We all have it, but we don't know how it functions and how to make the most of it in the most efficient manner possible. So, yes, we are really looking forward to this. Thank you so much, Padma.
Thank you. Thank you all. Thank you for showing up at 9 o'clock. That's very nice. It was encouraging for me to see so many people on the screen. Yeah.
Yep. Thank you. All
Thank
right.
you.
All right. So
Right.
I'm going to stop
Yeah.
the
Good
recording
night.
now. Yes. Thank you. Good night, ladies.